Most small business owners don't seek funding because they're failing. They seek it because they are building, because they want to grow faster, move quicker, handle pressure, or capture opportunity. And if you've ever felt like the lending system isn't seeing your business clearly, you are not alone. Many small businesses struggle to get strong funding, especially when they need it most, and very few are ever shown why. If you've been looking for real answers, you're in the right place. You'll learn what's needed to get the right funding at the right time on the right terms. This training will pull back the curtain on how lenders think, giving you the insights to stop guessing and the confidence to start getting stronger yeses. To begin, let's meet Chad. Chad owns a small restaurant in Phoenix. Nothing fancy, just good food, steady customers, and a place that's always busy. Most nights, there's a line out the door. He's got regulars, great online reviews, a team that shows up, and enough demand that he's thinking about opening a second location. But there's one problem. Chad needs capital. His cash reserve is limited, and this isn't the kind of money he can get from family or friends. So Chad does what every business owner in a similar situation is told to do. He applies for funding. Chad knows that without external funding, it's going to take much longer for him to expand his business. He fills out the application forms, uploads his bank statements, gives them his EIN, his revenue, his tax returns, and then he waits, hoping for a yes. A few days later, the answers come back. Denied. No explanation, no clarity, just a quiet no. What makes it worse is what happens next. A week later, Chad is talking to Peter, another restaurant owner down the street. He has a smaller place, fewer customers, not nearly as busy. But Peter just got approved for a big line of credit. Low interest, long terms, no personal guarantee. Chad is stunned. Same industry, same city, same economy, but somehow the weaker looking business got the better deal. So Chad does what any rational person would do. He asks himself, what am I doing wrong? Like Chad, most small business owners and entrepreneurs believe one simple thing. If my business is doing well, if I have customers, if money is coming in, then getting funded should be straightforward. That feels logical. It feels fair. Yet it feels completely wrong in the real world. Because every day something strange keeps happening. Over and over again, you see businesses that look solid, growing and busy, getting denied. And you see other businesses, sometimes smaller, sometimes messier, sometimes barely scraping by, getting approved for lines of credit, business credit cards, equipment financing, and working capital. It honestly feels like some unworthy businesses get serious funding while deserving ones often don't. And if you've ever been on the wrong side of that, you know exactly how it feels. You're sitting there thinking, how did they get that and I didn't? You know that you're not lazy, you're not clueless, and you're doing the work. Your business has customers, it has revenue, it has momentum. And yet, when it comes to funding, you keep hitting walls. Sometimes it's a flat no, sometimes it's a weak yes, with high rates, short terms, and personal guarantees that put your entire life on the line. So you start questioning yourself. Maybe my business isn't strong enough. Maybe I need more revenue. Maybe I need to wait longer. Maybe I picked the wrong lender. You don't know the answers and you need help. So you try again. Different form, different lender, different promise, same outcomes. And for a while, it feels like that's just how this world works. But here's the uncomfortable truth. This isn't bad luck. It isn't about timing, and it isn't because lenders are out of money. What you are experiencing is the result of something invisible, A system that is quietly scoring your business in the background. A system that decides who looks safe and who looks risky, often long before any human ever reads your application. And until you understand that system, every funding decision will feel random, unfair, and out of your control. Remember Chad? He still needs capital. After hearing that Peter got approved, Chad was stunned. Same city, same industry, same economy, but somehow Peter got the yes and Chad didn't. So Chad does what any driven business owner would do. He goes looking for a solution. He starts Googling, watching videos, reading articles, joining groups. And very quickly, Chad is buried in advice. Try this lender. This one approves everyone. Use that platform. This one is fast. That one doesn't check credit. So Chad applies again and again with different lenders. And sometimes he even gets a small yes. A low-limit business credit card, a tiny line of credit, a short-term loan. It feels like progress, but not all yeses are created equal. Behind the scenes, something unexpected is happening. Every lender Chad applies to is pulling data. Every form he fills out is creating a record. Every decision is being logged, not just by that lender, but by the entire funding ecosystem. And in the funding world, the house always keeps the data. So when Chad applies again, he's not starting fresh. He's dragging his entire history with him. Every maybe, every soft pull, every decline, every half approval. And when that data doesn't line up, Chad doesn't just look uncertain, he looks risky. That's the result of the guessing trap. Chad thinks he's increasing his chances by applying again and again, here, there, and everywhere. But he's actually training the system to see him and his business as inconsistent. And once that happens, getting a strong yes becomes harder, not easier. That's why some businesses keep getting worse terms over time. Lower limits, higher rates, shorter repayment windows, more personal guarantees. Not because their business is getting weaker, but because they keep guessing and hoping. And unfortunately, hoping without insight is just gambling. Let's step outside the lending world for a moment. Imagine Chad wasn't feeling well and he went to see a doctor. He walks in and says, "Doc, something's wrong. I'm tired. I can't keep up. I need help." And the doctor doesn't ask Chad a single question. He does no blood work, no scans, no tests. He just hands Chad a bottle of pills and says, "Try these." Stunned, Chad walks out thinking, what's wrong with this doctor? Because everyone knows real medicine starts with a diagnosis. You don't treat what you don't understand. You don't fix what you haven't measured. But that's exactly what Chad has been doing with funding. He felt the pain, he felt the pressure, he wanted relief. So he kept trying things. Different lenders, different offers, different promises. No diagnosis, no clarity, just guesses. And in lending, guesses are not neutral. They leave scars. Every failed attempt doesn't just not work, it reshapes how Chad looks the next time. It's like letting strangers scribble on your medical chart while you're still trying to figure out what's wrong. And the messier the chart becomes, the harder it is for anyone to help you. Because now even the good doctors see confusion on your chart. And in the lending world, confusion looks like risk, which leads to denials or bad rates and terms. Not because lenders are cruel, but because Chad has been unwittingly sabotaging himself. The result? Funding just feels unfair. Unfortunately, at this point, most business owners quietly start blaming themselves. Chad didn't just get denied, he felt rejected. It felt like the system was saying, Your business isn't good enough. Your work doesn't matter. Your effort isn't worth the risk. And if you've ever been denied, you know that feeling. It's not technical, it's personal. As a small business owner myself, I know that feeling too. I've felt it more than once. You start replaying everything in your head. Did I do something wrong? Is my business too small? Did I apply too early? Am I just not cut out for this? But here's what Chad and most business owners never get told. Lenders are not judging your dream. They are not evaluating your hustle. They are not weighing your potential. When you submit an application, a human often doesn't see it at all. According to the Federal Reserve Small Business Credit Survey, many online and fintech business lenders use automated underwriting systems that evaluate applications without any human review unless certain risk thresholds are triggered. In fact, industry reports show that automation now extends across the entire lending process, from the moment an application is submitted, through how accounts are managed, and even when payments start to fall behind. So when you submit a funding application, it goes into a system. That system first checks whether your business even qualifies to be looked at. It validates your identity, it checks your data, it runs your profile through its risk model, your name, your EIN, your history, your money habits. And if you don't pass that first filter, you don't get reviewed, you don't get considered, you get automatically denied. No person ever saw your story. No human ever judged your effort. The machine simply decided you didn't look safe enough. So when Chad gets a no, it isn't rejection. It's a filter. Something in the data made him look riskier than Peter. Not worse as a business, just riskier on paper. Which is why two restaurants on the same street can get completely different outcomes. One gets a big yes, the other gets silence. Not because one owner is smarter, but because one profile looks safer to the system. I'm Dale, a fellow business owner and entrepreneur, as well as a former high school and university educator. Over the past few years, while working with business owners looking for funding, I kept seeing profitable, legitimate small businesses getting told no by lenders. That pushed me to understand why this was happening, even though more money has been set aside for business lending than at any other point in recorded history. By the end of this video, you'll understand why treating funding like a guessing game quietly works against you, what lenders are actually evaluating behind the scenes, and how to shape your business so it becomes irresistible to the lending system. Up until now, Chad has been living in one money world, the business owner's world. People in this world think in terms of customers, market demand, momentum, and what a business could become. They believe that money flows to good ideas, strong growth, and future potential. This belief didn't come from nowhere. It's a holdover from an earlier era of banking when lending was relationship-based, when you walked into a local bank, sat across from a loan officer, and explained your story. Back then, your reputation mattered, your potential mattered, and human judgment played a central role. That kind of thinking feels natural. It feels real. So to Chad, the logic feels obvious. If the restaurant is busy, if reviews are strong, if revenue is growing, then getting capital should be easy. That feels fair. That feels rational. That feels like how the system should work. And this belief is reinforced by the world of investing. Investors care about upside. They care about potential. They care about what might happen next. But modern day lenders do not live in that world. They live in a completely different one. Lenders are not investors. They are risk managers. They are not asking, how big could this business get? They are asking, how likely is this business to pay us back? When you understand this, the confusion lifts. This is not a nuance. This is not semantics. This is the line that separates approval from denial. Chad walks into the funding system with a story. Peter walks in with a profile. Chad brings vision. Peter brings data. Chad talks growth. Peter shows stability. And the system only understands one of them. To a lender, your story matters far less than your stability. Your vision matters far less than your predictability. And your growth matters far less than how safe you look on paper. This is not a judgment. This is not personal. This is simply how risk is evaluated. Once you get this, a lot of things suddenly make sense. Like why exciting businesses get denied, why boring ones get funded, why rapid growth can actually make lenders uncomfortable. Chad wasn't failing. He was just playing the wrong game. So if lenders are not reading stories and they are not betting on potential, then what exactly are they looking at? They are looking at a scorecard, not a single number, not a magic score, but a collection of signals, pieces of data that together answer one question: how safe is this business? Every lender has their own version of this scorecard. Different weights, different thresholds, different rules, but they all pull from the same raw materials: your business identity, your credit files, your reporting history, your consistency, your financial behavior over time. A lender's scorecard includes consideration of your business credit score, but its scope is much broader than that. Interestingly, according to a 2015 NAV survey of small business owners, 45% didn't even know they had a business credit score. 70% didn't know where to find it, and 82% didn't know how to interpret it. That's what makes this scorecard so dangerous. Decisions are being made about your business using signals you were never taught to see. Some businesses generate clear, readable signals without realizing it. Others unknowingly do the opposite. That's what led to Peter getting yes and Chad getting no. Peter's business leaves behind a clean, steady, predictable trail. Chad's business leaves behind a noisy, thin, inconsistent one. Not because Chad is reckless, but because Chad has been guessing. The invisible scorecard does not care about how hard you work, how good your idea is, or how much passion you have. It only cares about patterns. Are lenders reporting on you? Are your balances stable? Are your payments consistent? Does your business look like it exists on its own? All of that data feeds the model, and the model decides whether you move up the ladder or slide down it. Often without explanation, often without warning, and almost always without anyone telling you why. This is where most business owners and entrepreneurs get completely stuck. Because what you see in the real world and what the lending system sees are two very different things. Chad looks at his restaurant and sees tables full, orders flowing, money coming in. It feels alive. It feels real. But the lending system doesn't see any of that. It sees files. It sees records. It sees timestamps. It sees how long data has existed, not how long Chad has been working. And this difference of viewpoints explains why outcomes feel so disconnected from reality. You might have been running your business for 3 years or more, but if you only got your EIN 6 months ago, or your business credit file was created 4 months ago, or vendors only started reporting on you just 2 months ago, then to a lender, your business is brand new. It's like moving to a new country. You might be 40 years old with decades of paying bills, earning money, and doing everything right. But to the local bank in that new country, you look like someone with no financial past, no credit history, no record, no proof. So you're back at square one, starting from zero. In the lending world, undocumented or poorly documented businesses are invisible. and invisible businesses get locked out of the premium financial system. They don't get the best funding, they don't get the lowest rates, they don't get flexible credit. They get what's left. High cost money, high pressure money, low breathing room money. The yes they get comes with so much pressure that on paper it quietly makes the business look riskier. This is often dangerous money, money that keeps their business alive today while quietly hurting them tomorrow. Invisible businesses end up paying a visibility tax, not because the business is broken, but because the system cannot see them clearly enough. It's like how insurance gets more expensive when risk is harder to measure. When the insurer's uncertainty goes up, the cost of protection goes up with it. Same with business funding. When the lender's uncertainty goes up, the cost of borrowing goes up with it. The result? Higher rates, stricter terms, a demand for collateral or personal guarantees. So instead of getting breathing room, invisible businesses get more pressure. They get stuck in survival mode, relying on dangerous money just to keep things going. Dangerous money pulls cash away from growth and locks the business in survival mode. At this point, you may be asking, okay, Dale, but how exactly? I hear you. Let me show you what that looks like in practice. Take two identical businesses. Each does about $300,000 a year in revenue and clears roughly $48,000 a year in free cash flow. That's $4,000 a month each business has available to pay down debt or to reinvest. Both businesses need $50,000 in funding to get through a tight period. Business A ends up with survival tier funding, $50,000 at 38% APR for 2 years. That's a little over $3,000 a month in repayments. So out of the $4,000 they had available each month, $3,000 is immediately spoken for. That leaves just under $1,000 a month in free cash flow to be reinvested in the business. On the other hand, Business B gets growth tier funding, same $50,000, but at 7% APR over 5 years. That's about $990 a month in repayments. For our purposes, let's call it $1,000. So out of the same $4,000 available each month, Business B still has $3,000 left for investing, while Business A has only $1,000. That difference separates surviving from progressing. Now watch what happens over time. After 2 years, Business A finishes its 2-year repayment cycle. Over that time, Business A had only $1,000 a month of usable cash. That's $24,000 over 2 years. Business B, over those same 2 years, had $3,000 a month of usable cash. That's $72,000. Identical businesses, same starting point, same amount of funding received. Yet one business had $48,000 more room to reinvest and stabilize in just 2 years. Now, Business B is still on the same loan and still has room every single month. Business A, meanwhile, is far more likely to need another survival tier cycle because it never had the room to build buffers, hire help, or improve systems. And when this pattern continues, the gap doesn't close, it compounds. After 5 years, Business A, with $1,000 per month for 60 months, had $60,000 in usable cash. Business B, with $3,000 per month for 60 months, had $180,000 in usable cash. That's a huge gap of $120,000. Cash that could have gone into hiring additional staff, running consistent marketing, upgrading outdated technology, and building cash reserves to absorb unexpected disruptions. Over time, the gap keeps widening. After 10 years, here's where each business stands. Business B finished its loan after year 5. Because it deployed its usable cash to strengthen the business, it wasn't under pressure to seek more funding. So for the next 5 years, Business B had the full $4,000 a month available. Business A, if it stayed trapped in survival tier cycles, was still living on scraps. Now look at the total usable cash each business had over that decade. Business A, at just $1,000 a month for 120 months, had a total of $120,000 in usable cash. Business B looks very different. For the first 5 years, it had $3,000 a month, giving a total of $180,000. For the next 5 years, it had the full $4,000 a month. That's another $240,000. Altogether, they had $420,000 in usable cash. Over that decade, Business B had $300,000 more usable cash to reinvest into the business. Money that could go into growth activities, creating more cash flow month after month. On the other hand, being invisible, Business A was locked out of the premium financial system. It was confined to survival tier funding, high cost money, high pressure money, low breathing room money. Funding that kept pulling cash away from growth. So 10 years later, Business A isn't just tired, it's hundreds of thousands of dollars behind a business that had the exact same starting line, but a repayment structure that preserved room to grow. That's what dangerous money really costs. Not today, but over time, quietly. And this is the lived experience of millions of small business owners and entrepreneurs. For them, this math cuts deep. It's not technical, it feels personal. Chad feels like he's being punished, but he's not. He's being filtered. Not because his business is bad, but because it's not visible in the way the system needs it to be. So when Chad asks, "Why won't anyone fund me?" the real answer is simpler than it sounds. They can't see you clearly enough to say yes. And when millions of businesses are experiencing the same pattern, it starts to distort how the entire system feels from the outside. What looks like scarcity really isn't. The feeling that money is scarce, that lenders are tight, that funding has dried up, this is not real. It's an illusion. There is more money set aside for business lending today than at any other point in recorded history. Data from the Federal Reserve shows that total loans in the U.S. financial system have grown from about $27 billion in the late 1940s to over $13 trillion today. This is money flowing across banks, credit unions, government-backed programs, private lenders, fintech lenders, revenue-based lenders, equipment lenders, and SBA lenders. So the problem is not supply. Is qualification. Trillions of dollars are literally sitting there looking for businesses to lend to. Not to invest in, to lend to. Remember, lenders are not investors. They are risk managers. They are in business to make money. Lenders don't make money when they say no. They make money when they say yes. But they only get paid when loans get repaid. So every lender is playing the same game. Find as many businesses as possible that look safe enough to pay them back. That's it. That is why you keep seeing ads everywhere. Get funded, apply now, no credit check, fast approvals. The money is real. The demand for borrowers is real. So what's missing? Businesses that look fundable. Here's the truth. There is more money than fundable businesses. Despite there being over 30 million small businesses in the US, Reuters reported that private credit markets alone have hundreds of billions of dollars in uninvested capital ready to be lent. The real shortfall is not cash. It is not lenders. It is not opportunity. It is fundable businesses. That's the bottleneck. Not money, not lenders, not opportunity. It's visibility. When your business is invisible or messy in the data, you don't get access to that ocean of money. You get pushed into a tiny, dangerous corner of it, an area that's expensive, an area that's short-term. with access to a narrow slice of money that traps you in survival mode. And that's why it feels like funding is scarce when in reality it is everywhere. So if money is everywhere and lenders are desperate to lend it, why do so many businesses still hear no? Because lenders are not looking for good businesses. They are looking for safe businesses. And safe has a very specific meaning inside the system. Safe means verifiable, predictable, consistent, and independent of the owner. That's what their invisible scorecard is measuring. Not whether you're talented, not whether your product is amazing, not whether customers love you, but whether your business behaves like something that can be trusted with money. Lenders are looking for opportunities to say yes, but they still have to filter for risk. To find yes-worthy businesses, they scan for patterns that tell them, this business exists, this business is stable, this business pays what it owes, this business stands on its own. That's why two restaurants on the same street can receive completely different offers. Chad and Peter don't look much different in real life, but on paper, Peter's business looks like one that belongs in the system. He easily gets yes. Chad's business looks like a question mark. Not worse, just less certain. And uncertainty is the one thing lenders cannot price. So they avoid it and say no. Or they charge you for it. Higher rates, lower limits, shorter terms, personal guarantees. That's not punishment. That's the visibility tax. And once you understand that, you stop asking, why won't they fund me? And you start asking, how do I make my business look safe to this system? And once you know what lenders are really looking for, something else becomes absolutely clear. Funding isn't random, it's tiered. There is a ladder inside the lending system, and every business is placed somewhere on it. At the bottom of this ladder are businesses that look risky. Thin files, no reporting, inconsistent data, no clear financial identity. These businesses only qualify for high-cost money, high-pressure money, low breathing room money, with daily payments, high fees, personal guarantees, desperation products. That's survival mode. As you move up the ladder, something changes. On paper, your business looks more real, more stable, more predictable, more independent of the owner. Now you qualify for longer terms, lower rates, larger limits, and revolving credit. This is growth money. And at the top of this ladder, that's where lenders compete for you. Multiple offers, low rates, flexible terms, credit lines you can reuse again and again. That's what Peter experiences. Chad, right now, doesn't. Not because Peter is better, but because Peter is further up the ladder. Every time Chad applies blindly, he's not climbing that ladder. He's just bouncing around at the bottom. And every bounce leaves another data mark that keeps him there. But when you understand the ladder, you realize something powerful. You don't need to be perfect. You just need to move up one rung at a time. Now here's the trap most people fall into at this stage. They realize there's a funding ladder. They see that there are better options higher up. They accept that they need to climb it. You also now understand what lenders are looking for. But like them, you don't yet know how to shape what the system sees when it looks at you. How do you actually move up this ladder? And this is where most people do the most human thing possible. They guess. They apply, they hope, they try another lender, they tweak a form, they try again. Chad has been doing exactly that. Every rejection feels like a fluke. Every new application feels like a fresh chance. But the system doesn't reset. It remembers. Every application, every inquiry, every change, every mismatch, all of it becomes data. And when you guess, you don't just risk another no. You train the system to see your business as chaotic, unstable, inconsistent, uncertain. That's how Chad ends up trapped at the bottom of the ladder. Not because he's bad, but because his data looks noisy, and noise sets off risk alarms. That's why guessing doesn't just fail, it actually makes things worse. The more you guess, the more desperate your profile becomes. And desperation is exactly what pushes you into high cost, high pressure, dangerous money. This is why so many businesses get stuck paying the visibility tax. Not because they're broken, but because they never stop guessing. At this point, something should feel very clear. Chad doesn't need more luck. He doesn't need better hustle. He doesn't need to keep rolling the dice. Chad needs visibility. He needs to see his business the way lenders see it. Because once you can see what the system sees, you can stop guessing. You can stop triggering the wrong signals. You stop damaging your own profile. You stop paying the visibility tax. You start playing the real game. And now your applications stop being experiments. They become confirmations. Instead of asking, will this lender say yes? You start asking, do I look yes worthy to the system? Because that question turns yes into something you can earn on purpose. It turns funding from a gamble into a strategy, from desperation into control. And this is exactly what Chad needs. A way to see his business the way lenders do, to understand where he really sits on the ladder, and to know what to fix in the right order to move up. Because the businesses that win in this system aren't the ones with the best stories. They are the ones that are most visible, most consistent, and most predictable. That's how Peter keeps getting yes, not because he's lucky, but because his business fits the model. And once Chad knows how to shape his business to fit that model, getting a strong yes starts to feel almost inevitable. Now, Chad finally understands something most business owners never see. Getting a yes isn't about luck. It isn't about saying the right thing. And it isn't about finding the perfect lender. It's about alignment. It's about seeing what the system sees before you apply, knowing where you actually stand instead of guessing, and shaping your business deliberately instead of hoping the next application goes differently. Chad doesn't need another pitch. He doesn't need another promise. He needs clarity, a clear picture of how lenders see his business today, a clear view of where he sits on the funding ladder, and a clear path for what to fix first, second, and third. That's what replaces guessing with control. Because once you can see the scorecard, the ladder stops being a mystery, and getting yes stops being a surprise. So stop guessing. See how your business is actually viewed by lenders and put yourself in position to get strong yeses. Because now you know that the lending system doesn't reward deserving businesses or even know if a business is unworthy. Instead, it rewards visible, stable, predictable ones. Your next step is a sneak peek into something revolutionary. Head on over to businessgetsyes.com/next. Link is also in the description below.